Good. We are live. It is Monday, and that means it's time for the real estate show. Hope everybody had a great weekend. We've been working really hard here at the office, onboarding new staff, getting on the phones with everybody because we have a lot of different solutions. And it's awesome getting on the phone with people and just hearing about their success stories. Last week, we had Jimmy, one of our apartment accelerator students, come in, and he crushed 4 deals in his first year. He's working on deal number 5. So we'll be releasing that one pretty soon. Also spoke on the phone with somebody, came out, learned from us, and he's got over 50 units now. And it was an awesome phone call because he was just thanking us for everything we do. But today we are covering how to analyze a real estate deal. Let's be honest, at the end of the day, if you can't analyze a deal, you have no idea what type of deal you're getting into, and that's where you make some really expensive mistakes. When I first started out looking at the single family home deals that I was doing at the time, I had no idea what I was doing. This was before YouTube really took off, so I would look at this deal. I would know my mortgage payments. I would kind of know what I thought I could get for rents, and that was it. Now that I'm on the other side, like we just closed on a 136 unit deal in Tampa. The amount of work that goes into analyzing and underwriting that type of deal is astronomically higher than what I was doing at the start. So today I want to walk you through whether you're doing a 10 unit deal, whether you're doing a 50 unit deal, 100 unit deal. I want to walk you through the exact process that you can use to make sure you're getting all the right information, uncovering all the hidden secrets that a deal has, so you don't end up in a bad spot where it's like, oh shit, like I should have known this 3 years ago. Okay. So the way I break down deal analysis is in 3 distinct stages. It is called the 3 T's of underwriting. So the first T we're going to talk about is the today T, today. Because as soon as you look at a deal, you have to know what is happening in that deal today, not down the road. That's what the broker is going to sell you. The broker and the seller are going to sell you, hey, what the potential for this deal is. That's how they're going to try and jack up the price. But you have to figure out what is actually going on in real life for the property today. Because there's fluff, there's hocus pocus, there's the crystal ball type of stuff, but you're going to pay for the asset based on what is happening today. And there's a number of different things we have to do to figure that out. So the very first thing we have to do is get the rent roll. Now that's going to come in a couple different forms depending on the sophistication and the size of the property. If you're looking at bigger properties, the rent roll is going to come to you in an exported Excel format, really easy. If you're dealing with the smaller type of seller who's maybe owned the building for 30 years, you might be getting back of the napkin type of stuff. That's the 2 extremes, or sometimes there's none, which is even worse. Those are the extremes that you're going to be working with. At the end of the day, you have to know what unit you have. So it's a 1 bedroom, 1 bath unit. They're paying this much a month, and this is the name of the tenant. This is when they moved in, and this is when the lease is up. That's all you have to know. Okay. So very first thing you need is a rent roll. Then you need what's called the T12. So the T12 is basically the trailing 12 months of financials. So that's going to give you the rent that was coming in, all the different revenue. Maybe it's laundry, maybe it's parking, all those types of things. And then it's going to give you all the expenses. So, hey, this much went out for maintenance. This much went out for pest control. This much went out for turn costs. This much went out for staffing. All the operational types of expenses with the property. You're going to see bad debt. You're going to see debt where the tenant was supposed to pay and then they skipped town. All of this type of stuff is going to appear in the T12. Now, why do we want the T12 rather than just the last month of financials? It's because we're looking for trends. If you just get the 1 month or 2 months or 3 months worth of data of financials, that doesn't give you an overview of what's actually happening with the property. Let me give you an example. If we look past at 12 months, right? Maybe we see 4 months ago, occupancies started dwindling, and then right before they listed the property for sale, you see a whole bunch of lease ups. So maybe they had 6 vacant units, and then they just leased all of those up in a couple weeks before they listed. That's something you want to know, because before they decided to pump anybody with a pulse into that building, it was declining, right? But if you only get the last months of financials, you have no idea, right? Same thing. Maybe there's an issue with rents not being paid, right? Maybe you have a spike in late fees over the past 6 months compared with the start of the year. Well, what's going on in that economy, right? What's going on with your tenant base? Maybe there's employment issues, right? You have to dig in, because at the end of the day, this whole process of underwriting, the 3 T's, this is an exercise in asking questions. So you have to uncover some data and then ask a question, right? And then based on the answers you find, you're going to ask more questions. You're going to look under the hood to check out the engine and see what's really going on with that property, okay? I hope that makes sense. So we're looking for the property today. So you get the rent roll, you get the T12. Now, if you don't get the T12, you can get the T6, so the trailing 6 months. But we don't want to go based on 3 months, 2 months, or even 1 month. You need to get financials. Now, here's a question a lot of people ask. They say, and this happens with the Apartment Accelerator program, we get a lot. So when students start first looking at properties, they say, hey, Seth, the seller's not willing to give me any financials until I rate them on offer, right? Sometimes you get that with the smaller properties. The answer to that is you have to stand your ground and say, look, Mr. Broker, there is no way I can actually write you an offer that I can follow through on until I get the financials. Like, how am I supposed to know what's going on with the property if you want an offer first? Do you want me to retrade on the deal? A retrade is where you have an offer agreed upon and then you go back to the table and renegotiate the deal because something's happened, right? Do you want me to retrade? I'm a man of my word. So when I give you an offer, that's what it is. But unless you're going to give me the financials, there's no way I could possibly know what's going on with the property, right? You have to stand your ground and get those financials, okay? A couple other things you have to do. So we've talked in past weeks about NOI, right? NOI is the driving force behind the valuation of assets. So NOI looks like this, and this is why you need the financials, right? It's called the net operating income. So what you're going to do is you're going to take your revenue, and this is going to be your rents. This is going to be, your other ancillary, revenue streams such as laundry, parking, internet, Wi-Fi, all that type of stuff. You're going to take your revenue. So let's say we have revenue of, let's just say we have your revenue. Then we're going to subtract your OPEX. Now, in the T12, this is going to be your operational expenses, your operating expenses. So you have your staffing costs, you have maintenance, repairs, all of that, right? So you take your revenue, subtract your OPEX, and that's going to give you your net operating income. Now, notice that the debt, the financing payments have no place in the NOI, right? Because financing's subjective. One owner may decide to buy the property all cash. Another owner may decide to leverage 50%, and a third owner, same property, they may decide to leverage up to 80%. That's going to impact the cash flow, but that doesn't impact the actual business operating at the property, right? The business, the operating expenses, the revenue remains the same. The owner has their own thoughts on how the property. So what we do for that is we draw the line right here, and then we subtract debt service, and that gives us cash flow. But the NOI right here is dictated by the revenue generated by the property and the operational expenses, okay? So that's the property today. You have to dive into this stuff as much as possible so you know exactly what's going on. We are trying to front load surprises before you write an offer and take possession of the property. It's not good enough to have a surprise pop up in year 2 and say, crap, I wish I figured that out. No, you have to front load it before you even write an offer. Number 1, so you don't overpay for the property, but number 2, so you can plan accordingly. If you know that you're going to have to replace the boilers, right, in the property in year 2, you can work that out in terms of your underwriting, your business plan, so you have money set aside. But if you don't figure that out up front, you're toast, right? You're going to have no money left over for that expense. You're going to be scrounging around, and that's going to throw off the rest of your business plan. So the exercise of underwriting is all about asking questions and then asking more questions based on the answers you just found. Okay, so that's today. Then we have to figure out tomorrow. What's going to happen to the property once you take possession and you start implementing your business plan? Because basically what you're doing is you're going to find a property and you're going to pull one of two levers, right? You've got your physical improvements and you have your operational efficiencies. You're going to pull these levers to increase the value of the asset because it all comes back to NOI. Remember how we take revenue and subtract OPEX, and that gives us NOI? The whole business plan is to drive that NOI, to force that NOI to go up. How do we do that? Well, number one, we can increase the revenue so we can raise rents, find other revenue streams. But number two, we can make the property more efficient so our OPEX goes down. And in a perfect world, we can drive that revenue up and then decrease our operating expenses, and that's going to make the NOI go up, which then improves the value of the asset and increases it. So tomorrow, when we're figuring out what's going to happen with the property, you're going to set up your game plan. So game plan number one, how are we going to increase rents, right? That's what we have to figure out. So when we're figuring that out, we have to decide, well, how much are we going to spend per unit? And if we spend this much, how much rent might we be able to get in the marketplace? Because here's the thing. Let's say this is the standard of the market right now, and you're acquiring the property under standard, and you have 3 other properties operating at market level. Your job is to bring that property up to market standard. So maybe right now you're achieving $1,500 a month in rent per unit on average, and maybe market standard is $1,800. So that means the delta here, the difference between where this property is at, operating below market efficiency, and the actual market, there's a $300 difference, right? This is what we're looking for, because now when you can take possession of the property and you're going to spend X amount per unit, but you're achieving that $300 increase, that matters a lot, right? Because if we're going to take this out, let me just pull up my calculator here. So let's say you have 100 units at this property and you're going to increase $300 per month. This is just an example, right? $300 per month times 100 units. So that's $30K in revenue per month times 12. So that's $360,000 worth of revenue per month. Now what we do is we're going to divide it by the market cap rate, which let's just say it's 5%. So you've just generated $7.2 million in terms of increased value of the asset just because you're able to raise the rents up. Now, that's just an example I made up. On another session, we can actually walk through an actual deal and show you step-by-step how we do this thing. Okay, so there is a lot of value in terms of increasing the rents because people buy these properties based on the money they can produce, based on the cash flow, the revenue, right? The NOI. So if you can drive up those rents, somebody's going to pay more for your asset. So the first thing we have to figure out is, well, where is the market standard? Where are market rents? And to do that, you have to find what's called comps or comparables. So let's say you have a 1990s construction build asset, right? So it was built in the 1990s. And you've got the paper borders around the kitchen if they haven't done any reno since then. So you've got a 1990s asset. Let's say it's predominantly 2-bedroom units, and they're all 1,000 square feet. You have to go out in that marketplace and find other apples to apples comparisons. So it doesn't make sense for you to go out and look at something that was built in 2012, right? That's a lot bigger, a lot newer. That property is going to have newer amenities, different construction, different size, probably higher ceilings, all that type of stuff. You want to find other assets in the neighborhood, in the vicinity of that asset that is an apples to apples. So you're going to find other 90s constructions with similar amenities, similar sizes, similar number of units. And then you're going to find out, hey, well, what kind of rents are these properties achieving in the marketplace? Like what are these properties renting for? Because if you find property A, maybe they're renting on average for $1,850, this one's at $1,775, and this one's at $1,800. That gives you a pretty good idea within $50 per unit of where the market's at. So you can be very confident that when you acquire this asset at 1,500, you're going to be, hey, if you just add, new kitchen door, cabinet doors, maybe if you replace the vanities, replace the flooring and paint, and knock down a wall, right, to bring it into how these ones look, you can be very confident that you can achieve those rents. The big mistake people make in the tomorrow phase is by guessing, by relying on fairy pixie dust. It doesn't work that way. You can't guess as to where the market is going to settle in terms of rents. You can't guess. You have to find a property that's actually performing right now in the marketplace like that. And ideally, you have to find a number of them, because one comparable does not make a market. Sometimes there are outliers where one property, because they are exceptional at the sales and the lead gen side, or maybe they're exceptional at whatever it is, they're overachieving in the market, they're outperforming the market. You have to find the market average, where the true market is resting. So if the true market is resting around like $1,800, give or take, well, chances are you can achieve the same thing as long as you implement the exact same business plan all these other properties are achieving. Now, to go one step further, let's say an asset you're looking at, maybe out of 100 units, maybe 20 of those have already been renovated to a new standard. And those properties are achieving a $200 a month rent premium. Well, it's already proven in the market, right? At that same asset, hey, if we do X, Y, and Z, we're able to achieve this new rent. Perfect, because chances are, like, it's already being proven, it's happening right now. So if you renovated another 40 units in that asset, so now you would have 60 renovated units. If you renovate another 40 of those units too could achieve a $200 premium per month. You're going apples to apples, you have all your comparables, but it's actually happening at the asset itself. That's even better, right? Because you know exactly this is what we can achieve. And then once you improve the operations, you get new staff in there, you train them better on how to convert leads and sign them up, all of that stuff, well, maybe you can achieve a $250 premium, right? With better systems and operations. This is what we're figuring out with tomorrow. Where can you take the property today and move it to your ideal business plan, the stabilized asset tomorrow? This is what you're figuring out with the tomorrow section here. Okay. And then with tomorrow too, you have to worry about your financing. You have to worry about, hey, well, what are the taxes going to be like once I take over this asset, depending on your location? Sometimes taxes change as soon as you sell. So you have to go through that process. Hey, what are my distributions? Am I going to send out checks to my investors every single quarter? Are they going to be monthly? What other changes are going to happen? And then you have to worry about staffing, because sometimes there's properties where they have too many staff members. Maybe they're too top heavy. Maybe they have 3 people working on admin at the property and you only need 2. Well, in that case, you're going to make some changes in terms of how the property is operated to be more efficient. Because if you're paying each person $70K a year for their services and you really only need 2, well, you just saved yourself $70,000 and that's going to go to your bottom line. So let's just say it's even a 6 cap, right? $70,000 a year saved at a 6 cap. That's $1.17 million in terms of value just added to that asset by making that change and changing the operations of the property to make it more efficient. This is the power of your 2 levers. You got physical improvements and then you have operational efficiencies. Let me just throw a couple more examples at you here. Let's say you have one asset down the street, very similar to you, but they have a gym, they have a business area, and they have a dog park. But people are willing to pay $150 more per month for those amenities and services. Where you're going to look at your asset and say, oh, okay, well, we're basically the same for everything else. We are $150 behind this property in terms of monthly rent. But if I just add a dog park, which is very inexpensive to do, if I add a gym, which isn't going to break the bank very much, that's going to be part of your capex that you inject into the property. If you add those, well, now you can achieve $150 rent premium. This is where it's at. You're not guessing. You should never guess with this stuff. You never want to be the first person to try it in the marketplace. You want to bank on what is proven to be true in the market with true apples to apples comparisons. Okay. Once we figure out today where the property's at right now, and then we figure out your business plan, where is the property at tomorrow, now we have to do the third T, which is, I call it the terminus, because honestly, I needed a word that started with T, because we never used to have the three T's of underwriting. We had TT and then E, TTE. The three T's sounds better. So I used to call this the exit. What's going to happen when I just think of, what's that show? The Walking Dead, where there was a, Ravi, did you watch The Walking Dead, Ravi?
Yeah.
Wasn't there a city called Terminus in one of the episodes? I can't remember. Anyways, I think it comes from The Walking Dead. Anyways, so Terminus. What happens at exit? There's a number of assumptions you have to make about the market for when you sell or when you refinance, okay? Number one, how is the market going to be behaving when you choose to exit this property? Let's say you buy at a 5 cap right here, right? You're buying at a 5 cap, which means that investors are going to pay you a 5 cap for each dollar of NOI produced. So let's say, for example, your NOI, your net operating income for the deal is, let's say, $1.5 million per year. At a 5 cap, that's going to give you a valuation of $30 million. Bang on. Great example. I guessed it right. Okay, so $30 million. Right? Let's say the market softens, so the cap rate's going to go up. So now instead of a 5 cap, let's say it's a 5.5 cap. Well, your valuation drops by $3 million, right? So now the property is only worth $27 million and a bit. If it goes up to a 6 cap, $5 million. So you just lost $5 million of valuation. So what is the lesson here? You have to assume that the market's going to be performing worse. So be a worse market, a softer market, a more unfavorable market than when you purchased the asset. So let's say when you purchased at a 5 cap, you need to assume that somebody's going to pay less for each dollar of NOI produced by the property. So maybe you're going to assume that the exit cap is going to be a 5.5 cap or 5 3/4 cap, right? Or maybe go up to a 6 cap, whatever it is. You're going to have all these different scenarios. I'm going to touch on that in a second. You always have to assume the market's going to be worse because that's going to give you wiggle room, right? You never want to assume the market's going to be better than when you picked up the asset, than when you acquired it, okay? Now you have to make some other assumptions about the market. So you have to assume, hey, well, what are the broker commissions going to be? What are going to be the fees to get out of the debt on the property? You have to figure out all of the fees, right? Because that's going to impact your profits. And then, you have to figure out, hey, what is the time frame? So if I acquire this asset, do I think is the ideal time to exit in 5 years? Is the ideal time to exit in 3 years? Am I going to do a quick fix and flip here with this asset and get out in 2 years or less? You have to figure this out in your business plan to have any investor conversations, have any lender conversations. This is why we have to think ahead. You're figuring out what's happening with the property today, what's happening with the property tomorrow, and then what's happening with the property at exit. So here's the deal. You have this beautiful spreadsheet. You figured out exactly what's going on with the property today. You figured out exactly what's happening with the property tomorrow. Now we have to break that, right? You have to find the weak spots, the weaknesses in your deal. What happens if all of a sudden your occupancy plunges by 20%? Can you still stay afloat in the deal? Can you still exit? If you need to refinance, let's say the market goes to shit and you can't sell. Are you able to get new debt at a way more expensive rate than what you're paying today to keep the deal afloat? Yes or no? If the answer is no, well, you have to go back to the drawing board and shore up those parts of the deal to make sure you can weather the storms. What happens if there's a huge increase in cap rates? So cap rates go from 5 cap to a 7 cap. Does the deal still work? Yes or no? Can you exit and still make money? If the answer is no, can you hold on to the deal and weather the storm? If so, do you need more debt? If so, can the property qualify for debt? Does your debt service coverage ratio, which we talked about 2 weeks ago, does that still meet the requirements of 1.25? If not, go back to the drawing board, figure out how you can make the deal work. What other things can you do in the deal to make sure you're hitting those standards that you've set for yourself so you can still exit? Right? Because when you're building a deal, when you're structuring a deal, these are all the things you have to think about, right? It's not good enough. It's not good enough just to look at an asset and buy it and hope for the future. This is what amateurs do. Amateurs don't make money in real estate. Professionals, they seek to control. They seek to control everything you possibly can. We know for sure we can't control government policy. We can't control interest rates, but we can control the price we buy an asset at, the types of renovations we do, the timelines, our strategy. That's what we control. So a professional investor will seek to control everything they possibly can. And this is why the 3 T's are so important, because we're getting under the hood. We're discovering what's actually going on with the asset so we can come in and control everything we can, right? Don't be an amateur. Amateurs lose money. Amateurs hop on bandwagons. That's good enough. That's not good enough. We have to control everything we can, okay? So we're trying to break your deal at this point to figure out the exit. Maybe you have a couple options, right? Maybe one option is just to refinance, return all investor capital, and then you're holding the deal indefinitely. That could be one option. Or maybe the second option you have is we're going to sell. Well, if so, who is the likely buyer, right? Is it an institutional group? Is it, depending on the size of the deal, is it a mom and pop? If so, how can we make the deal more attractive to those types of people? Is the plan to offer some seller financing to sweeten the pie? If you're doing renovations, are you going to renovate 100% of units? Or are you going to leave meat on the bone for the next buyer so they can come in and make some money? So maybe you're only going to renovate 80% of the units, 60% of the units, 70% of the units. So that way the next buyer who's going to be doing the same business plan as you, they can come in, acquire the asset, and still earn the money and drive up that NOI even more. These are all the things you have to think of when you're underwriting and analyzing the deal. Okay, so we got today, tomorrow, and Terminus. And the biggest mistake I see people make, well, there's mistakes all over the place, but let me just cover the 3 biggest mistakes I see. Mistake number 1, with today, not getting all the right data. So this thing is kind of like, it's a conveyor belt. You put garbage in, you get garbage out the back. So if you're just guessing on all of the different expenses you have, if you're just guessing based on the rents, if you're putting garbage in, you're going to get garbage out the back of the system and you can't rely on it, right? With tomorrow, when you're planning for the property tomorrow with your business plan, biggest mistake I see, people guess. They just make up renovation numbers. They don't walk the property. They don't know the exact state of the physical well-being of the asset. They don't walk it. Or they look at 2 units out of 50 and they just guess. Or they just make up rough construction numbers. Maybe they Google the cost of doing some work at the asset rather than actually having a contractor come out, look at the job, quote the job, and then you have a realistic scope of work. You have to create a scope of work. If you don't, you're just making things up, right? If you're visiting the asset and you're walking it and you're like, oh, well, this needs to get done, this needs to get done. And then you call up the contractor and say, hey, listen, I'm acquiring a 75 unit property. I got to renovate like 80 and this is what we're doing. You're just going to get a garbage quote. You have to have a scope of work all laid out so every single unit, the contractor knows exactly what has to happen. Remember, garbage in, garbage out. If you're just making stuff up, you're going to get a made out number out the back and you have no idea what you can actually pay for this asset, okay? And with the Terminus, biggest mistake here is people not putting their deal through the ringer, not running through those worst case scenarios on what happens, because it's happened over the past couple of years. People get into debt issues. They can't refinance. Rates go up. If they weren't doing the stress test before, they have no idea what's going to happen with the deal. I have some friends right now, rates went up, whatever, but they stress tested the deal. So you're like, oh, well, this is a really shitty situation, but you know what? I actually looked at the numbers and the deal still works. We just have to stay in for another year. Perfect, all right? It's not an unexpected surprise because the worst thing in real estate investing is a surprise. If you know what's going to come up down the road, even though you don't want to think about it. It's the worst case scenario. But as long as you've gone through the exercise and you have a plan for it, you're in good shape. It's those unexpected like left hooks that come out of nowhere. That's what knocks people down. So with the Terminus, not going through the stress test and painting too rosy of a picture of the future. You have to assume the future is not as good as it is today. All right. So those are the 3 T's of underwriting we got today, tomorrow, and the exit. Now, once you've gone through the underwriting, you actually have to make the deal happen. And there's 4 components of every deal. It's the real estate matrix. You need the deal, you need the financing, you need the management, and then you need the equity. And most people, unless you have millions of dollars in the bank, you have to go out and raise money from other investors, right? This is a whole subject on itself. And this weekend, coming up on July 20th and 21st, myself and Brad Blazer, we are running a 2-day capital raising intensive in Toronto. So just go to go.sethferguson.org/capital and you can get your seats. Small group. Like, this isn't the conference I run where we have thousands of people. This is a small group. It's not beginner basic type of stuff. We're talking about family offices, institutional capital, and we're talking about retail. We're literally giving you our investor attraction systems, the scripts we use, the call processes, how to close people, the ads you can run, the different ways you can get people in the funnel, how to structure a deal the right way, whether you're syndicating, launching your first fund, doing a joint venture. We're literally giving you everything step by step, A to Z on this type of stuff. So if you're interested, we have general admission and VIP. VIP is basically sold out because I think we have like 50 people in the VIP almost. Holly just sold 2 this morning and we're almost capped there. So if you are interested, small group, it's all content. There's no fluff. It's 2 days. It's at Ryerson University in Toronto, 2 days of solid content. So if you are raising money, you need to be there because your ability to raise capital is the single most important skill you can master to scale your business and portfolio. You have to be able to raise that money. So join me in Toronto coming up this weekend, July 20th and 21st, me and Brad. It's going to be awesome. 2 tickets. We've got general admission VIP. So just go to go.sethferguson.org/capital and get your seats before they are gone because the team's working across the way right here through the wall, and they have sold a bunch already this morning. All right, 3 T's of underwriting. You have to know this stuff, and I'll see you this weekend at the Capital Raising Intensive. See you guys then.